Next time you sit down to eat, think about this for a second. The financial systems funding the very creation of that food are completely, fundamentally misaligned with the people actually out there growing it. Welcome to This Explainer. Today, we're taking a deep dive into a truly fascinating policy proposal by Dr. Gothanda Moorthy called the Permanent Cultivation Fund, or the PCF. This isn't just a minor tweak to the rules. It's a proposed national agricultural finance reform that aims to completely rewire how we fund farming. We're talking about moving away from old, rigid banking models and shifting into a system designed specifically for the messy, biological realities of modern cultivation.
Okay, let's dive into this by looking at the ultimate paradox of our current food system. You have millions of tenant farmers and sharecroppers out there sweating in the fields, literally putting in the back-breaking physical labor to produce the nation's food. But because they don't hold the actual title deeds to the land they work, they are systematically excluded from formal credit. The very people who are most central to our food supply are the ones left entirely out in the cold by the banking system. It's wild when you think about it.
So, here is our roadmap for today's explainer. We're going to systematically break this down into 5 parts. First, the broken collateral system. Second, from ownership to production. Third, funding through existing capital. Fourth, yield-backed repayment mechanisms. And finally, number 5, de-risking through cultivation credibility.
All right, jumping right into part 1, the broken collateral system.
Imagine two entirely different universes crashing into each other. On one side, you have commercial banking logic. It demands strict land ownership, hard collateral, and, well, completely inflexible repayment schedules. On the other side, you have agricultural reality. Farming doesn't care about the fiscal quarter. It's dictated by biological cycles, highly unpredictable weather, and seasonal income realization. Because banks demand paper deeds, a highly skilled cultivator who simply rents their land becomes completely invisible to lenders. Their actual productive capability, their talent for growing food, means absolutely nothing to a traditional bank if they don't hold that piece of paper.
And the real-world fallout here is pretty severe. Since tenant farmers are locked out of formal institutions, they're forced right into the hands of exploitative, informal money lenders. It's a trap. Because traditional loans ignore actual harvest cycles, cultivators are put under massive structural default pressure right out of the gate. And honestly, the worst part? When an unavoidable natural disaster strikes, say a devastating flood or a severe drought, that crop failure is absurdly treated as a personal borrower failure. The system literally threatens the cultivator with asset seizure over a weather event they couldn't possibly control.
Which brings us to Section 2, from ownership to production. Now, it's absolutely crucial to get this right. The Permanent Cultivation Fund, or PCF, is not just some conventional bank handing out cash to farmers. Not at all. It is a national digital cultivation finance ledger and settlement infrastructure. It essentially operates as a sovereign accounting system that finances food production based on active cultivation rather than the accumulation of property.
So, the crucial point is that this requires a massive shift in how we define financial legitimacy. Right now, we operate on ownership legitimacy. The right to borrow is based purely on what you own. The PCF totally flips the script to production legitimacy. Under this model, financing eligibility flows directly from a farmer's demonstrated capacity and commitment to actually cultivate the land. The cultivator is no longer viewed as a risky rural borrower. Instead, they are treated as an operator of sovereign food production infrastructure. Think of them almost like a licensed public utility contractor, whose job is keeping the entire nation fed.
Moving on to Section 3, funding through existing capital.
Okay, whenever a massive national policy like this is proposed, the immediate question, the elephant in the room, is always the price tag. How in the world do we fund this massive new cultivation infrastructure without slapping a huge new fiscal burden on the taxpayer? Well, the proposal's answer is actually incredibly elegant. It requires absolutely zero net new government spending.
The secret sauce here lies in priority sector lending, or PSL. See, under the current model, commercial banks are already mandated to allocate capital to agriculture, but they do it through heavily fragmented individual loans, dealing with duplicated assessments and awkwardly trying to manage individual agronomic risks that, frankly, bankers don't truly understand. The PCF model changes the game by creating a unified capital pool and a centralized registry. Banks simply take their existing PSL-mandated capital and pool it into one national fund. They meet their capital obligations, but, and here is the huge win-win, they are completely relieved from having to manage complex agricultural realities on a case-by-case basis. All that agronomic risk, it gets pooled nationally.
Let's get into Section 4, Yield-Backed Repayment Mechanics.
So how does a farmer actually experience this on the ground? It's a three-step flow. First, instead of carrying a dusty land title into a bank branch, they complete a digital cultivation registration, basically detailing exactly what they are growing and where. This gets validated via satellite imagery and local ground records. Step 2, the system uses direct ledger settlement to provide the necessary agricultural inputs. And finally, Step 3, when the season wraps up, repayment is linked entirely to the yield post-harvest.
Let's look closer at that middle phase, because it's a real game changer. Conventional systems rely heavily on cash disbursement. And let's be honest, cash is notoriously leaky, highly prone to inflated billing and funds getting diverted to things other than farming. The PCF eliminates cash entirely from this step through direct ledger settlement. If a farmer needs seeds, fertilizer, or machinery time, the PCF settles the accounts directly with approved cooperatives and public utilities. This brilliant safeguard cuts out the most common pathways for misuse and ensures the funds go exactly where they are supposed to, straight into the ground.
I love this quote from the source. The cultivator mortgages what they produce, not what they own. Under the PCF, repayment emerges organically from the harvest itself. If those crops are bought through government minimum support price procurement systems, the PCF settlement is just automatically deducted right at the point of sale. If they're sold privately, the proceeds are channeled back through the ledger. You only pay back when you actually realize your income from the yield. It aligns perfectly with the biological cycle.
Finally, Section 5, de-risking through cultivation credibility.
But you might be wondering, what happens when nature just doesn't cooperate? And this brilliantly illustrates the solution, a three-layer risk architecture. Layer 1 is the PCF handling the actual cultivation financing. Layer 3 is the cultivator handling the production execution. And sitting perfectly in the middle is Layer 2, the insurance system strictly for climate and nature risk absorption. So if a monsoon completely fails, it triggers an automatic insurance settlement. It does not trigger a debt recovery proceeding that ruins the farmer. Operational execution is explicitly separated from systemic climate risk.
As farmers operate within this system year after year, they build up what's called cultivation credibility. The digital ledger continuously tracks their yield history, their cultivation continuity, settlement consistency, and their compliance with approved input usage. Over time, this portable digital record becomes the farmer's most valuable financial asset. It progressively replaces the physical land title. It creates this incredibly powerful built-in incentive for sustainable farming and honest reporting, because their data literally becomes their financial leverage. So, why does all this matter to you and me? The systemic impacts outlined in this proposal are profound. First, it creates the structural inclusion of tenant farmers, finally pulling them away from exploitative and formal debt. On a macro level, the ledger generates real-time, nationwide data for food security. And because climate risks are insured and repayments are linked to actual yields, we see a drastically reduced need for those politically disruptive blanket loan waivers. This matters to every single one of us. Stabilizing food production and removing massive default pressures directly impacts inflation, taxes, and the prices we all pay at the grocery store.
Now, to be totally objective, a system this huge isn't going to roll out without some serious friction. The source acknowledges real implementation challenges. Verifying claims at scale using satellites to prevent fake ghost farming claims is a major technical hurdle. You also need strict governance to prevent local elites from capturing the cooperative supply chains. Plus, sustaining high-integrity digital infrastructure and coordinating with state procurement agencies is going to be incredibly complex. But these are necessary evolutions, and the proposal suggests phased rollouts in pilot districts to thoroughly test these safeguards before scaling nationally.
Which leaves us with this profound question to wrap up on. Should we finance what a farmer owns or what they grow? The Permanent Cultivation Fund makes a compelling case that food production is sovereign infrastructure. It argues we must shift from a debt-centered, land-obsessed system to one that truly supports the act of cultivation itself. It's a fascinating paradigm shift to ponder. Thank you so much for joining me for this explainer, and as always, keep questioning the systems that build our world.